I'm Oliver Sloup with Blue Line Futures, coming to you from the Chicago Board of Trade with another episode of Tech Talk. It's Tuesday, November 30th, last trading day of the month, and occasionally on the last trading day of the month, you get fireworks that come along with that, and that's exactly what we got today. And it wasn't just in the grain and livestock sector. We also saw the equity markets roll over again, crude oil take another leg lower, and even the historical safe haven assets, gold and silver, getting hit pretty hard. And I think a lot of this was not only the end of the month trading, but also we got some Fed speak from Jerome Powell, and that really shifted the tone of the market from the early morning hours into a risk-off atmosphere, and it was kind of a sell first, ask questions later. And also with the new Omicron variant, there's some concerns about that, but I don't think that that was the biggest catalyst in today's sell-off across a wide variety of markets. I think this was end of the month. I think this was Fed speak, and a lot of it very technical. So let's get into the technicals. We've got four markets for you today: corn, soybeans, wheat, and live cattle. To kick things off, we've got the March corn contract pulled up here, and we talked about it in the Grain Express here recently. The top end of the range, $5.95, to up to $6. Technically and psychologically significant. It was the top end of the recent range as well as the top end of the range there from the middle of August. We failed that, and I think that triggered some long liquidation, especially when we broke below the recent low end of the range, or just kind of the middle of this pocket here, that mid 575 area, and that really sparked a leg lower towards this breakout point from October 27th and 100-day moving average. I think this is a pretty good support pocket, 555 to 560, and I wouldn't be surprised to see that hold on the first test. So if you've been short from the top end of the range, you might want to consider reducing that short exposure. If you're bullish this market, you may want to consider legging into some long positions, whether that be via futures, options, or a combination of both. We're pretty active in these markets, so if you have a question on how to play it with some limited risk, feel free to give us a call, shoot us an email. We'll be able to help you out. But these are the risk ranges as of now. The bulls want to defend this 560, 555 area, break and close below, and that could spell disaster for the bull camp, because I would assume that would spark some additional long liquidation from the funds, which we know have a massive net long position. A break and close below here takes us back into this 520 area for that March contract. Now moving over to the soybean market. Soybeans also rolled over pretty good here today, and again, it was broad-based risk-off atmosphere in the marketplace. Soybeans I'm a little bit more friendly on here, but these day-to-day gyrations are going to be very tough to stay in the market if you're just trading on futures. If you have a tight stop, you're likely to get stopped out in this environment. So we're looking a little bit further out in time to the March options, and we're playing it to the upside via some spreads. I think there's a good risk-reward trade here. If the input costs for corn come down, I think that would be supportive for the soybean market, and I think a lot of people are just kind of writing off soybeans as there's nothing bullish about it, and really there isn't. But when everyone's in an agreement on something, you might start wanting to look on the other side of things. So we're optimistic on soybeans, not to the point where we're going to be aggressively buying futures with clients, but looking at some call spreads out to March to give us some upside potential with limited risk on the downside. We've hopefully can mark a higher low here. We marked a higher high over the last week and a half. Hopefully we can mark a higher low. We can get this market moving back north again towards that psychologically, and as you can see here, technically significant $13 handle. So that's what we're looking at for the January beans and out to the March contract as well. Now, wrapping things up on the grain side is the wheat market, and we talked about the corn and wheat rather in this morning's daily Grain Express, which is our daily commentary about how sometimes these markets can be an escalator up and an elevator down, especially when you have the length in the market from managed money that we have seen in corn and wheat. And today is a perfect example of that. Not just today, but the last four trading sessions, shaving off almost $1 from these recent highs. And this 780 levels, what we outlined in the Grain Express as being support. Wouldn't be surprised to see that hold on the first test. And again, as mentioned with corn, you're going to see some wide intraday swings. So if you're trading futures, God bless you. There's a lot of other ways to play these markets with limited risk going forward. And I talked to many clients here this morning that didn't have a position on, and they wanted to get involved with wheat, but just because it's moving, it doesn't mean you need to get involved. Resist the FOMO or the fear of missing out. There's no need to initiate a new position right now just because you see it flashing red on the screen. So that's kind of what we're looking at for wheat. This 780 level is a must-hold area for the bull camp. A break and close below there, I think, not only neutralizes the bullish technical landscape that we've seen here over the last several months, but also probably flips the script a little bit and puts the bears in control, and we could potentially see another dollar lower towards this psychologically and technically significant $7 handle, which really you don't have to go all that far back. It was the middle of September that we were at that level. Now, wrapping things up with a little bit more conviction on the live cattle. We've been talking about wanting to see the market consolidate and pull back from last week's bull run to the upside. We pulled back to trendline support here and this support pocket. So I think this is a buying opportunity for the February contract. We've also been working with clients out in the April futures as well, looking to the long side to see if this can't hold on the first test. This is our risk zone, so a break and close below here, we'll probably take our medicine and move on. There's still a gap that's open down here from November 18th, so that's something to keep an eye on as well. But first test, we like buying here. Break and close below, we'll probably reset, wait to see if we can't retest this gap, fill the gap, and the 100-day moving average a little bit closer towards 136. But all in all, still upbeat on cattle as the fundamentals continue to firm and managed money continues to add to their long position, something that we've been talking about for quite some time now, finally getting the move here over the last couple weeks that we've been looking and waiting for. So that's what we're looking at. That's what you should be looking at too. This has been Oliver Sloup with Blue Line Futures from the Chicago Board of Trade. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors. Thanks a lot.